Welcome. We are back again to look at the question that I told you I'm going to solve today. We learned the computation of ratios, profitability ratio and liquidity ratio. And we did illustrations on those questions. But I've said that I am going to solve a full question on profitability and liquidity. So I am going to read out the questions. You will also see the question displayed on the screen. So take note of the question, and after that, I will give the solution. ABC Corporation comprehensive statement of comprehensive income for the year ended 31st December 2022. We have the profits or loss statement here. We start from the revenue and ended with the profit for the year. Profit for the year being 155,000 naira. And then we have the statement of financial position as at 31st December 2022. Of course, the total assets is 800,000 naira. Now we have additional information which stated that the outstanding shares is 50,000 shares. Then the market price per share is 20 naira. And then dividend per share is 1 naira. Dividend declared 50,000 naira. We are required to calculate for profitability ratios, gross margin ratio, operating margin ratio, net profit margin ratio, return on assets, ROA, return on equity, ROE, return on sales, ROS, earnings per share, EPS, price earning ratio, P/E ratio, dividend per share, DPS, dividend yield, earnings yield, and return on capital employed, ROCE. The second one is to calculate the following liquidity ratios: current ratio, quick ratio, and cash ratios. These are the ratios that we are going to calculate today. So we will start with the profitability ratio. And the first ratio we are going to compute is the gross margin ratio. Gross margin ratio, we have already given the formula to be gross profits over revenue or sale multiplied by 100 over 1. And if you look at the question, you will see that the gross profit was given at 400,000 and the revenue was given at 1 million times 100 over 1. If you solve this out, it will give you 40%. So what does this mean? It means that for every naira of revenue made by ABC Corporation has a gross profit of 40 kobo. So for every naira revenue, they are making 40 kobo. That is the meaning of that. Now we want to go to another ratio, operating margin ratio. We've given the formula as operating profit all over revenue multiplied by 100 over 1. And in the question, the operating profit is 280,000. 280,000, while the revenue still remains 1 million. Multiply by 100 over 1. This will give us 28%. This ratio indicates that for every naira of revenue, ABC Corporation has an operating profit of 28 kobo. Then we move to net profit margin ratio. We said net profit margin ratio is net profit, which is profit after tax, over revenue, multiplied by 100 over 1. Then the net profit we had was 155,000 over our revenue or sales, multiplied by 100 over 1. It gives us 15.5%. This ratio indicates that for every naira of revenue, ABC Corporation has a net profit of 15.5 kobo. That's what they have as net profit. We go back to another ratio, return on assets. Return on assets we have also given as net profit over total assets multiplied by 100 over 1. And the net profit we have already seen is 155,000. And then the total assets in the question is 800,000. 800,000. If you solve this out, you will have 19.38%. This is telling us that ABC Corporation generates a return of 19.38% on the total assets. So their return on the assets of the company is 19.38%. We go to the next, return on equity, ROE. Return on equity is net profits over total equity multiplied by 100 over 1. Of course, we also know, we have also seen our profit, net profit is 155,000, while the equity is 500,000. 500,000 multiplied by 100 over 1. The resultant effect is 31%. It means that ABC Corporation generates a return of 31% on its total equity. We had already given you the components of equity, so we are sure you know what the equity represents here. So the return to equity holders is 31%. Return on sales is just like the operating profit that we talked about. So it's the same thing. Operating profits over revenue times 100 over 1, which will give you, operating profit here is 280, and the revenue is 1 million. So if you solve it out, you have 28%. 28%. The operating margin ratio also gave us that value. This is what I call other profitability ratio. Earning per share is net profits over outstanding shares and 55,000. However, the question says the outstanding shares are 50,000 shares. That's the outstanding shares. Remember that this must be shares that has been issued already. And when we solve it, we have 3 naira 10 kobo. This ratio indicates that ABC Corporation has an earnings per share of 3 naira 10 kobo. So for every share that ABC has, it earns 3 naira 10 kobo. If you are a shareholder in ABC and ABC decides to pay out all their earnings in dividend, you are going to receive 3 naira 10 kobo per share. The other one is price earning ratio, PE ratio, as we call it. Price earning ratio is equal to market price per share divided by earning per share. So the question gave us that the market price per share was 20 naira. 20 naira. And then we solved before for earning per share. Here we have it. Earning per share is 3 naira 10 kobo. So this will give us 6 naira 45 kobo. This ratio indicates that investors are willing to pay 6 naira 45 kobo for every naira of earnings. Every naira of earnings, investors are willing to pay 6 naira 45 kobo. We have dividend per share. Dividend per share was given in the question as 1 naira. This ratio indicates that shareholders receive 1 naira dividend for every 1 naira share held in ABC. Last time I have said that it's not all the earnings of the business that are paid out as dividend. So this is the amount of the earnings they paid out as dividend. So everyone that holds a share there will receive 1 naira for every share that you are holding. If you have 20,000 shares, you are going to get 20,000 naira. Then we have dividend yield. Dividend yield, we have said that it is dividend per share over market price per share. And the dividend per share we have is 1 naira. And then the market price per share is 20 naira times 100 over 1. The resultant effect is 5%. 5%. This ratio indicates that investors can expect a dividend yield of 5%. A dividend yield of 5%. Then we have earnings yield. Earnings yield. Earnings yield is equal to earnings per share divided by market price per share times 100 over 1. And our earnings per share, which we have already worked out, was 3 naira 10 kobo. And then we also have market price per share, which was 20 naira times 100 over 1. If you work this out, you have 15.5%. 15.5%. This ratio indicates that investors can expect an earnings yield of 15.5%. Now, return on capital employed, ROCE. The formula for ROCE is operating profit over capital employed multiplied by 100 over 1. First, we need to calculate the capital employed. And our capital employed here is total equity plus non-current liabilities. In the last lecture, I told you that I gave you two formulas to calculate capital employed. I said it could be total assets minus current liabilities, or equity plus non-current liabilities. Here, the total equity is 500,000 plus the non-current liability is 150,000. 150,000. So our capital employed is equal to 650,000. Now that we've gotten the capital employed, it is easier for us to calculate the rows. Operating profit here is 280 all over 650 times 100 over 1. We have the result is 43.08%. 0.08%. This indicates that for every naira of capital employed, the company generates a return of 43.08 kobo. This is all the profitability ratio that we have computed. Now we are going to look at liquidity ratios. The first one is current ratio. Current ratio, like we said before, is current assets divided by current liabilities. In the question, current asset is 300,000, while current liability is 150. So 300,000 over 150. This will give you 2. 2. We can express it as 2:1 in proportion. 2:1. This ratio indicates that ABC Corporation has twice as many current assets as current liabilities. That's what it means. The next one is quick ratio. I said quick ratio can be called acid test ratio, can also be called liquid ratio. And we also discussed the difference between the current ratio and quick ratio. The difference being that the slow moving item of current assets is removed, is excluded from the computation of quick ratio. So what we are to do here is to remove inventory from the total current assets and then divide it by current liabilities. In the question, inventory is 80,000 naira, and then the total current asset is 300,000 naira. So 300,000 minus 80,000 all over 150. So our current ratio is 1.45:1. This ratio indicates that ABC Incorporation has 1.47 times as many liquid assets, excluding inventory, as current liabilities. So if you want to be more conservative in calculating your liquidity ratio, you can use the quick ratio as we have learned. The last ratio we are going to calculate in this is cash ratio. Cash ratio, as we learned, is cash and cash equivalents over current liabilities. Cash and cash equivalent here is 100,000 over current liability 150,000. This will yield 0.67. 0.67. This ratio indicates that ABC Corporation has 67% of its current liabilities covered by cash and cash equivalents. These ratios are used to determine the ability of the company to meet their short-term obligations as and when they fall due. This is a very simple question on ratio of profitability and liquidity. When we are done with the whole ratio class, we're going to bring more complicated questions so that you will not think that this is just all. Those questions will solve them, will give you the questions and solve them. And you see how complicated ratio questions could be. It's not only by solving and getting the answer. The major issue about ratio is the interpretation of ratio. Since it shows relationship, through ratio, you can even draw up a full financial statement. We will look at all those things when we are done with solvency and activity ratio. Thank you.